pass tax legislation that requires 60 votes in the Senate. However, back in 1985, actually, there was a senator by the name of Byrd who passed a special rule which allows the U.S. Senate to pass tax legislation with merely 51 votes.
Welcome to the Swiss Money Secrets podcast, a podcast designed to cover all things offshore investing and banking from the Swiss perspective. Let's get into it.
We have added some more people to the Swiss Money Secrets podcast for this week. We have Jonathan Tiegerman, Neal Weiss with us today to cover what we think is a very interesting and important topic. As everyone knows, Donald Trump will be the president of the United States in 2025. So today we're going to talk about kind of what the tax implications look like, what the tax regime is going to look like. We're going to let Neal and Jonathan share their expertise. They're part of Tiegerman Tax and Advisors. So maybe Jonathan and Neal, you guys can let our audience know who you are, where you're from, your expertise a little bit, so they can get to know you a little bit more.
Hey, thanks, Jess. We are a team of U.S. tax advisors located here in Zurich, Switzerland. Our team is comprised of attorneys and accountants, and we help our clients with U.S. international tax planning matters as well as tax reporting and compliance. Our clients include companies, entrepreneurs, wealthy families, and individuals. And we're very happy to be here with you today, Jess.
Yeah, cool. Thanks. Neal, maybe you could give some background.
Yeah, I guess quick background. Originally from Canada, started working in international tax with one of the big fours. Moved to Switzerland a little over 8 years ago. No intention of kind of leaving. And I joined Tiegerman Tax Advisory. Earlier this year. I do a little bit more on the compliance side, whereas Jonathan kind of handles a little bit more of the advisory work, and kind of together everything kind of flows really well. So yeah.
Cool. Yeah, well, we're excited to have you here. Before we jump into our topic, we're all living in Switzerland with various different backgrounds. In our last episode, we talked about why Swiss people cared about elections, and now we want to kind of talk about what we've been seeing in terms of the reaction to the election and what we've seen. So maybe, Jamie, I'll let you take off with that one.
As the token Swiss person.
As the token Swiss person of the podcast, yeah.
I think as was a little surprising to us, the news were filled with all the election results and analytics in the days afterwards. What I think was very interesting on the day that the election results came out here, Wednesday, the evening of that day, the German, essentially, government also fell apart a little bit. And that got very little coverage. I think if it would have happened any other day of the year, that would have been the headline for the coming days. But with the US election happening that day, that was a little bit lost in the noise. And I think considering that Germany is our largest neighbor, it just shows how interested the Swiss are and how big of a topic it was here as well.
Yeah. What did you guys see in your circles in terms of the reaction? I know for me it was surprising. I had cast my vote weeks back, but didn't really look at the elections thinking there's not going to be a result for another 5 days. And when I came into the office, Jamie and Urs were already watching the election, and it was surprising and I think shock to everyone that it was already so clear who the candidate was going to be.
Well, I had noticed that in the news that it was the first time in 20 years that a Republican presidential candidate had won the popular vote. The last time that a Republican presidential candidate had won the popular vote was George W. Bush in 2004. And so it was a very clear and decisive outcome from the perspective of voters, right?
Yeah, I know. I was just a bit surprised at just how decisive it was. There were a lot of talks that it would be more of a coin flip. And then you really need to kind of wait to the last second, a little bit kind of like 4 years ago, with kind of the votes being counted. But yeah, I woke up early in the morning and already saw that there was quite a large in favor of Trump and the Republican Party. And yeah, it ended up being a landslide victory for them.
Yeah, with that, I think we can move on to our main topic, which is understanding the tax regime in general, also understanding the international component, to what it's going to look like under Trump. So maybe, Jonathan, you could start out with kind of giving us a picture of the legal process of what it's going to look like to change things, how much is going to change, and maybe we can dive in at that point.
Sure. Thanks, Jess. It's a really interesting time for U.S. tax practitioners, and also, I guess, for Americans in general who are focused on how the new presidency will affect the tax situations of folks. It's a notable outcome that a single political party has control of the presidency, the White House, as well as both houses of Congress. So Trump will take office. He'll be inaugurated in January, and the Senate has a fairly strong majority of Republican senators. 53 seats in the Senate are held by Republican senators, and then there's a very small margin in the House. As everyone knows, American politics are extremely polarized, and so being able to unite a party and to get the votes necessary for passing any sort of legislation, it's a very large effort. Typically, as U.S. tax legislation goes, to pass tax legislation, it requires 60 votes in the Senate. However, back in 1985, actually, there was a senator by the name of Byrd who passed a special rule which allows the U.S. Senate to pass tax legislation with merely 51 votes. So basically, that means that there's quite a margin that the Republican Party has in order to get some sort of tax legislation done. The catch is that in order to use this mechanism, what's referred to as reconciliation, the tax legislation needs to be revenue neutral. That means that any tax cuts have to be offset by tax revenue elsewhere. And so for this reason, we've received a number of inquiries. It's a very popular topic here in Switzerland. Do we think that there could be an end to taxation of Americans abroad? Could there be a change to residency-based taxation? And I think as a firm, we're a bit tempered in our expectations. Just to kind of give everyone a sense of where the U.S. deficit is currently, it's around 55 trillion, the U.S. deficit. And the current projections by the Congressional Budget Office are that extending the Tax Cuts and Jobs Act would cost somewhere between $4.5 and $5.5 trillion, adding that to the deficit. And that's without considering certain other promises that were made. So point being, in order to use this mechanism of reconciliation, they would have to find revenue elsewhere. So things like ending taxation of Americans abroad, they would have to find a pay-for provision, and it's simply not an easy thing to do. In terms of timing, I'm sure that the Republicans will be hard at work. They're much more organized this time around with this administration as opposed to the first time that Trump took office in early 2017. So I think that the legislation the public will be much more keyed in. There'll be much more movement next year in 2025. And I think the party as a whole will be much more organized. But I think the Republicans will also be very motivated. There's going to be midterm elections in 2026. And I think the difference in 2 years is that 20 Senate seats for Republicans are actually up for re-election, whereas only 13 seats for Democrats are. So the Republican Party really needs to be motivated, needs to move quickly to get their tax agenda pushed forward.
Yeah. Neal, do you have anything on that?
Yeah, so that's super good points, Jonathan, because especially looking at if you are going to make these type of changes to the tax, which is going to require money to come into the government from elsewhere, that's where I think a large part of Trump's campaign was, in his favorite word, tariffs. So he was talking a lot about including tariffs on pretty much any import into the U.S. He was looking at figures of 10 to 20% on any import to the U.S. and then specifically targeting China and including a rate of 60%. With that being said, it is a pretty controversial thing. Even within the Republican Party, you have a mix of opinions on it. I mean, I think tariffs were kind of really popular back in the days. They kind of disappeared. Especially, a lot of the Trump campaign was to, lower cost of goods, which just with inflation have gone up, a lot. And I think historically, tariffs have, led to an increase of prices, especially, things occurring domestically and things being imported. So who knows? I think there's, you just look online and you look at what economists are saying. There's also kind of a mixed approach. So it could go over well, it could not go over well. I guess kind of, time will tell. So that's definitely kind of, one, I think, large thing that the Trump campaign are going to be pushing. Another thing that they were looking at is to increase the child tax credit. So that's something that kind of benefits families, with children. And that's something that also, the Democratic Party we're talking about. So that seems like maybe something where the two parties are kind of aligned. We might see something like that happen. Currently, it was about $2,000 as the child tax credit, with the additional child tax credit being about $1,600 that's actually refundable. So they're looking, right now the figure that they brought out was about $5,000 to increase it. So that's something that would be interesting to kind of follow. And at least kind of what we've seen a little bit with our clients here, the child tax credit, you used to not need a social security number for your dependent. But with the change to the legislation back in the start of 2018, they required you to need a social security number. So we have a lot of clients. We see that these are Americans. They moved abroad, and they have their child abroad, and they're Americans. But they don't think to necessarily kind of apply for the social security number right away. So we see that's something where if you don't have the social security number available by the deadline of the return, you can kind of lose out on those credits. And another kind of interesting tip, but just for people abroad, when you claim the foreign earned income exclusion under Section 911, which kind of a lot of our clients do, that's kind of a way to eliminate some of your employment income working abroad. You also don't get to claim the additional child tax credit, which is the refundable portion.
Yeah, that's very interesting. Yeah, that's surprising in terms of how they exclude and what rules tick in or tick out based off of what types of exclusions you're looking to get or what your tax situation is. So I think it's very practical in terms of understanding of what might be coming. Now, I guess just a little question I had on that is, do you think that these tariffs are in the mind of the Trump administration to be that offset for that tax neutral movement? Because from the projections that I've seen, they wouldn't be tax neutral even if he slapped on these very high tariffs. All the tax cuts he's proposing don't seem tax neutral. And I guess a follow-up question to that one is on the Tax Cut and Jobs Act. Obviously, we're going to see that end, but to extend it, does that also need that neutral kind of barrier?
Yeah, it's a great question. So basically, when they passed the legislation or proposed to pass the legislation, the Congressional Budget Office will score the legislation. They'll basically analyze each of the provisions that are in there and then figure out how much revenue is expected to be raised if it's a pay-for provision, and if it's a tax cut, what the cost of the provision is. As I recall, the current projections for the tariffs, they are included. It is a pay-for provision, and I think they're expected to raise somewhere between 2.5 to 2.7 trillion. Yeah. Unclear how they projected that figure, right? But even including the tariffs, there's still clearly a gap of 4.5 to 5 trillion, which they'll have to make up for. And all the projections are currently based on an extension of the Tax Cuts and Jobs Act for a 10-year period. So I think one of the things that could come onto the table is, rather than to try to extend it for a 10-year period, they might look to extend it for a shorter period, maybe for a 4-year period. Because like you said, the Tax Cuts and Jobs Act provisions are all scheduled to sunset effective end of 2025. So you're going to see a lot of changes coming through based on the legislation.
Yeah, and do you guys see that the potential of that to be renewed or extended as a very likely chance now that there's a Trump administration, or do you see that as, okay, we think they'll rework it and come up with something with a new name that maybe feels a bit fresher or more to the American public at that moment?
Well, I think that there are specific provisions that will probably be easier to extend than others, right, Neal?
No, for sure. Some that are definitely going to be a lot easier. So some of the big ones that they're looking at is especially the SALT, which is state and local taxes. That's kind of one where right now, kind of when the Tax Cuts and Jobs Act came out, they put a cap of $10,000 on it. And that's one of them where if they if it sunsets and that goes away, they were estimating about, I think it causes about $100 billion of lost revenue every year for having it. So that's something where they could either maybe extend that, even though they have also been talking about eliminating it outright. But then again, there's so many things that they want to change, but it costs a lot of money, and then you need to find a way to bring in money to compensate it. We also saw the federal income tax rate for individuals. It dropped from 39.6% to 37%. That also was kind of a loss of revenue. They also kind of widened the income tax brackets. So that's something where they might not want to renew that, or again, Trump has made kind of a lot of promises to kind of lower taxes, and I think he's super optimistic about kind of how profitable kind of the tariffs will be. So kind of that's something to be seen. And then a really big talking point within the items that are supposed to sunset with the Tax Cuts and Jobs Act are the lifetime federal tax and state exemption. So starting in 2018, it went from pre-inflation figures 5 million, and it was doubled to 10 million. And then when you look at the updated inflation figures today, we're looking at, I think, just under $14 million per U.S. citizen or green card holder domiciled in the U.S. So these are large amounts, and what that meant was if you were to kind of pass away, the first 14 million roughly of your net worth would be fully exempt from U.S. estate tax, which at the moment is 40%. So that's quite high. So that's probably, I'd say, the largest talking point within the TCJA at the moment, because there's been a lot of planning occurring with the assumption that it's going to sunset and go back to its original 5 million pre-inflation, which they're guessing right now could be anywhere in the 6 or 7 million range. So for people that maybe have assets above 7 million, but maybe below 14 million, you're really in a spot where you kind of want to act quickly. People now are maybe saying if it does get extended, there's no real urgency, but personally we like to kind of be conservative and say, hey, you want to lock in the guaranteed exemption today, because the IRS at least has announced, or at least Treasury's announced that there is going to be no clawback on that. So if you do utilize any of the exemption, the higher exemption today, and then it gets reduced, you're still okay.
Yeah, so they're not going to come back asking for tax dollars over in that 14 million mark, whatever, if it's 6 or 7 million, they're not going to come back asking for it.
Yeah, that's right.
Yeah.
It's a really interesting point, though. The Republican think tank that's authored a lot of the policy and the publication that we know about, even though President-elect Trump has not specifically endorsed it, called Project 2025. They published a very detailed manual on specific tax provisions that they thought would be interesting. And as concerns the lifetime exemption and estate tax, the text that's in there is simply to reduce the estate tax percentage. But the exemption would not necessarily be as generous as it is today. So point being, if you are in the 7 to 14 million range, it's possible that you won't do any better. Now's kind of the time where you can kind of optimize if you're looking to pass assets to the next generation.
Yeah, that's interesting. And I guess on that, do you think that there's going to be a concerted effort? I don't know in super detail of Project 2025, but do you think that they would be more likely to go in reducing the percentage, or do you think Trump is going? I mean, he is a billionaire himself. Obviously, 14 million doesn't mean much to a billionaire. I mean, it does mean something, but do you think the likelihood of that being extended or the reduction of percentage paid on the inheritance is more likely to come about?
Yeah, if you think about the way that that those numbers probably affect Americans, if you already have accumulated, let's say, 7 to 14 million of net assets, then you're doing really well. You're not really you've exceeded the middle class, but I think for the ultra wealthy, having a lower percentage estate tax rate is probably moves the needle more for you than having that additional exemption amount.
Yeah. Okay. That makes a lot of sense. And I guess from this, is there anything that you think that extra should be brought up, or should we kind of move on to, okay, let's get down to the bread and butter of how do I move forward as a person? How do I strategically make sure that my structuring is in the right way for my future? Do you have any points that on the U.S., like in terms of the Trump administration changing things, or do you think that we should, talk about how you can, I guess, strategically approach that kind of process of ensuring that you're going to get the most out of everything?
There's a famous physicist from the 1920s called, he was named Niels Bohr, and he coined the phrase, prediction is difficult, especially when it's about the future. So I think our view is that we would recommend relying on the rules that we have now. The rules that we have are actually the most generous that we've ever had in the history of U.S. tax law. And so sometimes, or I think most of the time, certainty is more valuable than fairness. So if you have certainty about a plan that's beneficial for your family's wealth and being able to do some planning, then I think to us that's probably the best way forward in 2025. And then I think in 2025 we'll start to kind of learn more. We'll kind of probably see bills come both out of the House and out of the Senate. So we'll start to get an idea of what that looks like and what the Republican Party internally has negotiated at each of the houses within Congress. But again, I think that they have probably until the end of 2026 to actually finalize the legislation. And so long as they sign it into law by the end of 2026, it can be effective January 1, 2026. So unclear exactly what we're going to see happen in 2025.
Yeah, okay. And in terms of, I guess, looking at an estate that's in the U.S. and an estate that's abroad, what are some of the strategies that you guys would look at in terms of making sure that they are, let's say, a client of 7 to 10 million, making sure that they're actually being effective with their tax strategies?
Yeah, the U.S. is kind of an interesting place in that Americans are taxed, subject to estate tax on worldwide assets, but even non-Americans are actually subject to estate and gift tax if they have property located within the United States. So I think it's incredibly important that folks be aware of it, make sure that that they have the right advice, the right advisors on the wealth side, on the tax side, so that way they're prepared for whatever outcomes kind of wait for them, either in life or at death, and that they're kind of prepared to transfer assets to the next generation, whether that's setting up a trust vehicle or setting up some sort of a legal entity. Incredibly important for families who are operating small businesses, closely held businesses, how to pass business interests on to the next generation. A lot of entrepreneurs want to transfer assets to their kids and to their grandkids, but they want to continue to be involved with the business. They want to continue to have control of day-to-day operations. And I think all of that kind of factors into really a comprehensive plan that makes sense from a wealth planning perspective as well as from a tax perspective.
Do you guys have any kind of final thoughts that you want to give our listeners?
Yeah, I think kind of what we've talked about is there's still a lot of unknowns ahead of us. obviously now with kind of, you know, the Republican Party having, you know, their foot into all levels of the government right now, there's maybe a larger likelihood that maybe things go their way, but I still don't think it's going to be kind of a smooth, easy process for them. So what we do know right now, at least, is, you know, the Tax Cut and Jobs Act is going to expire the end of 2025. So I would probably still proceed with kind of planning according to that. Of course, later on, if it is extended, or if some of the items are extended and some are not, you know, then you can kind of reassess and deal with it then. But in the meantime, what we know now is these are the rules, and that's kind of what we kind of recommend to follow.
Fully agree.
For our listeners, if you want Jonathan or Neal's information or Tiegerman Tax and Advisors information, will be in the notes, so you can follow them there. Thank you guys for coming in today. Really appreciate it and all of the insights you guys shared.
Thank you to WHVP for inviting us.
Yeah, thank you, Jess. Thank you, Jamie. Pleasure to be here.
Thanks again for joining us on this episode of the Swiss Money Secrets podcast. If you would like to learn more about WHVP and what we do, check us out on our website at whvp.ch. Or you can check us out on any of our social media handles on LinkedIn, Facebook, YouTube, or Instagram by simply searching WHVP. Have a great rest of your day.